Silver isn't going up the way people think. Here's the contradiction nobody is ready to explain. Prices are rising on screens, headlines call it a rally, but on the ground, coin shops are cutting buyback prices overnight. Refiners are refusing metal, physical exits are closing. That is not how a normal bull market behaves. And this matters to you more than you realize. If you own silver, if you're thinking about it, or if your life depends on electronics, energy systems, or modern supply chains, this isn't just a chart problem. It's a system problem. Since 2020, the global money supply expanded by roughly 40%. Historically, that level of expansion doesn't unwind. It doesn't cool off. It forces assets to reset permanently because the currency itself has changed. Prices don't go back down to old baselines when the unit of account has been diluted. Now add one more detail most people skip. Gold gets hoarded. Silver gets consumed. It's burned into products and doesn't come back. And the market is still pricing it as if that difference doesn't matter. But here's where the story flips. Because the real pressure isn't showing up in the price yet. It's building somewhere else. And once you see where, the entire silver market looks very different. What's happening right now didn't start this year, and it didn't start with silver. The core event looks simple on the surface. Prices move up, volatility increases, commentators argue about targets, but that's only about 60% of the picture. The rest sits underneath, and that's where the pattern shows itself. For years, silver was treated as a side asset, cheap, abundant, easy to source. Mining investment dried up because prices stayed low for too long. Production shifted toward byproduct mining where silver is pulled out incidentally, not intentionally. That works only as long as the system stays calm. Now that calm is gone. At the same time, industrial demand didn't slow down. It accelerated. Electronics, solar, electrification, defense systems. Silver didn't get stockpiled the way gold did. It got used, consumed, removed from circulation. Quietly, here's the question most coverage avoids asking. What happens when a market designed for surplus wakes up in a shortage environment? Notice what isn't being discussed. Not whether silver is volatile, not whether it might pull back next week, but whether the system that priced it cheaply for decades can even function under today's conditions. Because this isn't about timing a trade, it's about whether the structure itself still works. The strongest claim so far is this: the silver market is no longer being priced by availability, it's being priced by habit. Here's the concrete detail that exposes it. Roughly 3/4 of global silver supply doesn't come from primary silver mines. It comes as a byproduct of other metals, lead, zinc, copper. That means silver production isn't responding to silver prices. It's responding to decisions made for completely different markets, and the grades are collapsing. Typical byproduct ore often struggles to reach 100 grams per ton. Miners are moving more rock, burning more energy, spending more capital just to get the same amount of metal. Meanwhile, the rare high-grade discoveries that actually make silver mining viable are geological outliers, not the norm. This matters because silver isn't being stored for later. It's being consumed now. Unlike gold, which gets locked away in vaults, silver disappears into electronics, energy systems, and industrial components. Once it's there, it's effectively gone. Now notice what's missing from most price discussions. There's no serious conversation about rebuilding supply, no fast path to new mines, no idle stockpiles waiting to be released. The system assumes yesterday's abundance still exists. That assumption is doing all the work. And once it breaks, pricing stops being theoretical. This is where the situation stops being abstract and starts to normalize something that shouldn't feel normal at all. In past cycles, silver spikes were events, short, violent, then they collapsed. The 1980 run is the reference everyone reaches for, a cornered market, a blow-off top, prices that couldn't survive once the pressure was released. That story trained an entire generation to expect reversions. But look at what's different now. Back then, money supply wasn't permanently expanding at this scale. Industrial demand wasn't structurally embedded into every layer of the economy. And silver wasn't treated as a disposable input the way it is today. The system could reset because the foundation stayed intact. Now the foundation is what's shifting. Low prices didn't just discourage speculation. They discouraged exploration. Projects were shelved. High-grade veins were abandoned. Capital left the sector. That neglect didn't show up immediately, but it compounded year after year. So when demand finally pushed back, there was nothing elastic on the other side. No surge capacity, no quick response, just a thinner, more fragile supply chain pretending it still lives in the old world. This is how abnormal conditions become routine, not through panic, through quiet acceptance. And once that happens, the next phase isn't volatility, it's escalation. The next layer of evidence is harder to ignore because it exposes a contradiction between what the market says and what it's actually doing. On one side, spot prices signal strength, charts look constructive, headlines talk about momentum, but underneath that, the physical system is acting defensive. Dealers aren't competing to buy metal, they're widening spreads. Buyback prices are being slashed well below spot, not because silver lost value, but because cash disappeared faster than metal could move. Some shops shifted from paying $5 back of spot to $10 back overnight. Not gradually. Overnight. That's not a pricing decision. That's a liquidity reaction. Now look upstream. Refiners flooded with material started refusing anything that isn't pure bullion. 90% silver, sterling, alloyed scrap. The door didn't slowly close. It slammed shut. That means dealers are holding inventory they can't liquidate, and the risk gets pushed straight onto the seller. Here's the detail that changes how you see this. When a market believes prices are fake, it keeps trading. When it believes logistics are broken, it stops. What you're watching isn't fear of lower prices. It's fear of being trapped. Now the pressure starts stacking fast. First, retail sellers rush in. Not because silver failed, but because volatility scares people into exits. That floods local shops with metal. Second, those shops realize they can't move inventory upstream. Refiners are clogged, cash dries up, spreads widen again. Third, the paper price keeps signaling strength, pulling in new buyers who don't see the bottleneck forming underneath. This is how control gets lost, not through a crash, but through speed. At the same time, bond markets start flashing stress. Long-dated yields jump sharply in places that are supposed to be stable. Central banks face a choice between defending currencies or defending debt markets, and they can't fully do both. Liquidity tightens globally, even as nominal prices rise. Notice how quickly these pieces collide. Physical silver can't move. Cash becomes scarce. Debt markets wobble. None of this was supposed to happen together, but it is. And here's the question that matters more than price targets or charts. What happens if this continues? This is the point where the story stops being about markets and starts landing in real life. Because when systems jam, they don't ask whether you're an investor. They don't care if you follow commodities. They show up anyway. In prices, in delays, in things quietly not working the way they used to. If you try to sell physical silver right now, you're not negotiating value, you're negotiating liquidity. The number on the screen doesn't matter if the exit is narrowed or closed. And that's a shock most people don't expect until they're standing at the counter. If you don't own silver, it still reaches you. Silver sits inside phones, cars, power systems, medical equipment. When supply tightens, manufacturers don't stop producing. They pay more. Then those costs move downstream, slowly at first, then all at once. This is how inflation actually feels. Not as a headline, as friction, as delays, as things costing more for reasons no one can quite explain. And notice how quiet it is when that happens. No announcement, no warning, just adjustment. If this feels familiar, say so in the comments, because the people who recognize the pattern early are usually the ones who aren't surprised later. At this stage, outrage doesn't explain what's happening. Incentives do. The system that sets silver prices isn't built to reflect scarcity. It's built to manage expectations. Paper markets reward liquidity, leverage, and speed. Physical markets care about inventory, throughput, and survival. When those two logics collide, paper can stay calm long after the physical side starts to strain. Here's the unsettling part. No single actor has to be malicious for this to happen. Dealers widen spreads to protect cash. Refiners reject material to protect capacity. Manufacturers pay whatever is necessary to keep production lines running. Each move is rational on its own. Together they create a squeeze. The spectacle stays focused on price charts because charts are clean. They feel controlled, but the real leverage sits in places that don't show up on screens. Warehouses, refining queues, shipping timelines, financing terms. This is how power works in stress systems. Not through announcements, but through bottlenecks. Whoever controls flow controls outcomes. And once markets stop asking, what is it worth, and start asking, can I get it at all, pricing enters a different phase entirely. That phase doesn't announce itself. It reveals itself after the fact. From here, the path forward splits, and neither option looks calm. One path is managed pressure. Authorities step in quietly. Liquidity is backstopped. Bottlenecks ease just enough to keep the system functioning. Prices rise, but in controlled steps. The narrative stays focused on volatility, not structure. Most people adjust without realizing anything fundamental changed. The other path is acceleration. Physical demand keeps pulling metal out of circulation. Eastern markets pay premiums that Western systems can't match. Inventory drains in one direction. At the same time, debt markets remain unstable, forcing policymakers to choose between higher rates or higher inflation. Either way, currencies absorb the strain. Notice what's already forming. Governments are reclassifying resources. Silver is no longer treated as a background commodity. It's being pulled into strategic conversations about security, manufacturing, and independence. That doesn't happen at the end of a cycle. It happens near the beginning of a reordering. Nothing here requires panic to unfold. It only requires momentum. And momentum, once it's established, rarely asks permission before the next move. Here's the insight that ties all of this together. What you're watching isn't a silver story. Silver is just where the stress became visible first. This is a story about a system built on assumptions that no longer hold. Cheap inputs, endless liquidity, smooth exits. All of that worked only as long as pressure stayed low. Now pressure is rising everywhere at once. When that happens, value stops being theoretical. It becomes physical. It becomes logistical. It becomes about access instead of prediction. And the people who wait for confirmation usually get it after the adjustment is already priced in. The quiet shift underway isn't whether silver goes higher. It's whether markets can keep pretending scarcity is optional. That question won't be answered in one headline or one candle on a chart. It will unfold piece by piece across assets, across countries, across everyday life. This is just one layer. If you want to stay ahead of the next one, follow the channel, because the most important signals are rarely the loudest. They're the ones the system reveals only when it's already changing.